Hello, my name is Martin McConnell. I'm a banking consultant with Provident Risk Management, and today we're going to talk about hedging commercial loans with interest rate swaps. Money center banks have used swaps as a tool to enhance their commercial lending operations since the mid-'80s. Many mid-sized and small banks introduced these swap products over the past 10 years, and now in the U.S., I'm working with banks as small as $500 million in assets to structure and market commercial loan interest rate swaps. The structure is simple. A financing is broken into two component parts: a credit transaction tied to a benchmark index and a rate transaction. By separating these two elements, we can price credit based on risk. At the same time, we can offer fixed rates without incurring additional market risk at the bank. Let's look at the cash flows for a back-to-back swap. First off, we have a floating rate note priced at a spread to LIBOR. Secondly, the borrower fixes the rate on the financing by entering into an interest rate swap. This swap eliminates the borrower's exposure to LIBOR plus a spread. Let's look at the cash flows. The borrower pays LIBOR plus a spread on the loan. On the interest rate swap, his bank pays LIBOR plus a spread. These two floating rate legs offset. The borrower is left paying a fixed rate. The bank lays off all rate risk with a dealer. The bank receives fixed, the bank pays fixed. The bank receives LIBOR plus a spread, the bank pays LIBOR plus a spread. At the end of the day, the bank gets a variable rate loan and the borrower gets a fixed rate financing. The bank has no exposure to interest rates. The borrower has no exposure to rising floating rates. There are a range of benefits to this back-to-back interest rate swap structure. Banks earn non-interest fee income on swaps. Banks can use their own deposits to fund loans, eliminating a reliance on wholesale matched fixed rate funding. Banks benefit when they can price credit based upon risk without being concerned about market risk and rate movements. Swaps allow banks to be much more competitive. In most markets, regionals or money center banks will offer your borrowers a swap-based financing. Swaps allow for more creativity and flexibility in developing the right loan structure for your borrower. Swaps reduce reliance on wholesale funding. Swap fee income is typically 25 to 40 basis points per loan transaction. Accounting for swaps becomes very simple with this back-to-back structure. The main reason is we're going to eliminate reliance on FAS 133 hedge accounting exceptions. Swap fees are recognized in earnings at inception. After that, our offsetting customer and dealer swaps create no earnings volatility. So why don't more banks use swaps? The answer is probably based upon concerns about the need for effective risk management and controls. To build a swap business and do it properly, you need swap policy and procedures. You need the swap valuation model. You need access on an ongoing basis to valuation reports. Credit is a key concern for banks, and it's important to develop a clear swap credit policy and to have access to a model to calculate credit exposure. Swap documentation needs to be put in place, and bankers need training and ongoing support. But you don't need to make a big investment to bring a swap capability to your bank. Off-the-shelf swap solutions are available today. Provident Risk Management and FinCAD together address all of a small bank's execution and risk management needs. We can provide policies and procedures. FinCAD systems provide independent valuations and credit exposure calculations. FinCAD's Fair Value Insight has a credit valuation adjustment model that allows banks to comply with the requirements of FAS 157. Provident offers an ISDA documentation system, and Provident provides swap sales support to bankers. Let's walk through a case study to see the steps we took to manage a swap for a bank client in the United States. It was a community bank with $400 million in assets, and it was making a loan to a German logistics company, a $3.5 million loan. The loan was provided to fund acquisition of real estate. It was priced at LIBOR plus 300. The loan term was 5 years, and the principal amortized over a 20-year period. The first step we take in the swap process is to develop pricing for a range of structures for our bank and our borrower. We're able to do this using FinCAD's Fair Value Insight. This system offers us a market standard pricing model, an open access system that is open to our auditors, and a system that is built around independent market data from ICAP, a leading interbank broker-dealer. Here we see where we've priced our 5-year interest rate swap in FinCAD's Fair Value Insight. You can see the notional amount is $3.5 million. The swap runs for 5 years, and we've offered a fixed rate of 5.37%. The swap will pay monthly, and the floating rate side of the swap is 1 month LIBOR plus 3.5%. FVI allows us to build any type of tailored cash flows, any type of loan repayment structure that a borrower might need. Once we've come up with the right price and the right structure, we then need to be concerned about credit and documentation. Credit is going to be about understanding the potential risk that a swap creates for the bank. And documentation requires us to put in place market standard ISDA documentation for our banks, negotiate that documentation, and make sure it's closed prior to execution. In Provident Risk's Transaction Manager system, we provide a checklist for credit exposure calculation and approval. For example, we review swap eligibility, and we provide for a calculation of swap exposure. Potential credit exposure is the amount that a bank might lose if a borrower defaults and markets have moved against the borrower. FinCAD's Fair Value Insight provides for a credit exposure model that allows us to calculate a maximum peak exposure. We can use this as a worst case evaluation of exposure, and we can take this number into consideration when approving the risk on a particular financing. Our Transaction Manager system provides for auto-generation of ISDA documentation. Each of our banks has its own standard form of ISDA, but all of these documents can be tailored to meet the specifics of a financing. It's important to review loan documentation to make sure that our loan agreement is going to work well with our swap agreement. So we review it for structure, we review it for collateral provisions. Typically, our swaps are cross-collateralized with the loan. And we review it to make sure our LIBOR payment mechanisms or prime payment mechanisms match those of our swap. Once the swap is set up with terms matching those of the loan, once we are comfortable with the potential credit exposure on the swap and we provided for collateralization, once our ISDA document is in place, when all of those steps have been taken, we're ready to lock in the rate and then simultaneously hedge the bank's risk away to a dealer. So let's look at the cash flows on this particular financing. Our borrower has a loan at LIBOR plus 350. The borrower enters into a swap with the community bank. The community bank pays LIBOR plus 350. The borrower pays 537. The borrower has effectively eliminated exposure to LIBOR plus 350 and locked in a 537 rate. Our bank simultaneously enters into a hedge with a dealer. The dealer pays LIBOR plus 350, and the dealer receives 5.02. The difference between the two rates, the 537 and the 5.02, is a 35 basis point swap fee to our bank. Here you can see in FVI, we value both the transactions at the time of execution. The swap where we receive 537 produces a gain to the bank of $56,000. Our offsetting dealer hedge has essentially no value, negative 138. Between the two transactions, the bank is fully hedged, the borrower has a fixed rate, and the bank has locked in a fee income of $55,879. Fair Value Insight provides the ability to value trades on a daily basis. Typically, our banks seek valuations on the day the trades are put on and then quarterly thereafter. Some banks will, to conform with FAS 157, will adjust the gains on their swaps to recognize a credit charge. Fair Value Insight includes a credit adjusted valuation model which takes into consideration the risk of the swap transaction, the credit spread of the borrower, and then produces a credit charge. This credit value adjustment meets the requirements of FAS 157. Fair Value Insight also allows us to stress test swaps to measure potential change in value under different rate environments. We can do this pre-trade, we can do this on a portfolio basis after the trade. So we've seen how we were able to put together a swap, we were able to offer pricing, we were able to manage credit risk, we were able to measure credit risk, we were able to execute, and then we were able to report the income on the bank's books. What are the keys to building a commercial loan hedging program at a community bank or a small bank? Firstly, we need bankers who want to use interest rate swaps to improve their competitiveness and to grow loan production. Secondly, credit officers at our banks need to understand how swaps create risk and how they can manage that risk. Thirdly, you need effective swap and loan documentation. We need to make sure our banks are secured in their swap positions. Banks must have access to models that allow them to independently value swaps. Banks need to know that when they offer a price to their borrowers, that it's a market price, that it does not place their institution at risk, and that the price that they're offering is the best available for their borrowers. Fair Value Insight provides a complete suite of valuation reports at the transaction, counterparty, and portfolio level, including credit-adjusted valuations and credit exposure calculations. To learn more about FinCAD's valuation systems and to learn more about how Provident Risk Management can help you develop a commercial loan swap capability at your bank, you can contact FinCAD directly, or you can contact me, Martin McConnell, at Provident Risk Management.